From semiconductor clusters to financial institutions, Southeast Asian banks redefine their strategies under the pressure of U.S. China decoupling. The global economic landscape is undergoing its most profound restructuring since the end of the Cold War, driven by the increasingly irreversible fracture in trade relations between the United States and China. Over the past decade, tensions that began with punitive tariffs have escalated into a comprehensive strategy of economic decoupling and de-risking, disrupting supply chain networks that had been built around cost efficiency for decades. Amid the massive relocation of manufacturing capital away from mainland China, Southeast Asia has emerged as one of the most attractive destinations. Yet, few people realize that behind the movement of factories lies a quieter but equally transformative revolution taking place within the region's financial bloodstream, Southeast Asia's commercial banking sector. To adapt to this new reality, financial institutions across the region have been forced to abandon traditional lending models, evolve into sophisticated geopolitical risk managers, and aggressively expand into complex cross-border trade finance services. The need for this strategic transformation stems directly from the changing nature of foreign direct investment flowing into the region. In the past, investment into ASEAN countries was largely concentrated in real estate, domestic infrastructure, and natural resource extraction, sectors perfectly aligned with conventional collateral-based lending practices used by local banks. However, according to capital flow monitoring reports from the Asian Development Bank, this structure has changed dramatically since the manufacturing relocation wave began. New investment from multinational corporations, as well as Chinese enterprises themselves, has increasingly targeted high-tech manufacturing, electronics components, semiconductors, and renewable energy projects in Vietnam, Indonesia, Malaysia, and Thailand. When these companies enter new markets, they require far more than simple construction loans for factories. They demand an integrated cross-border financial ecosystem capable of connecting seamlessly with global upstream and downstream supply chains. This reality has created a survival challenge for Southeast Asian banks. If they continue relying solely on traditional collateral-based domestic lending, they risk excluding themselves from the flow of global manufacturing capital. To capture this opportunity, leading regional banks such as Singapore's DBS, Malaysia's Maybank, Thailand's Kasikorn Bank, and Vietnam's Vietinbank and Techcombank have been forced to shift strategically toward advanced trade finance operations. Traditional trade finance once revolved around basic services such as letters of credit and payment guarantees. Today, under the pressure of increasingly fragmented supply chains, banks must develop more sophisticated supply chain finance solutions that provide working capital across entire ecosystems, from primary manufacturers to first-tier and second-tier suppliers operating across multiple countries throughout the region. The complexity of this new cross-border financing structure requires banks to possess superior digital capabilities and advanced data management systems. When products such as semiconductor chips or solar panels are manufactured, their components often move across several Southeast Asian countries before final assembly and export to markets such as the United States. Each stage of this journey generates financial needs, including inventory financing, receivables financing, and foreign exchange risk management. Southeast Asian banks are currently investing billions of dollars into integrating asset tokenization technologies and blockchain systems into trade finance platforms. These investments aim to reduce document processing times from several days to just minutes, ensuring that working capital moves faster than the physical flow of goods. This flexibility in financing, not merely competitive lending rates, has become the key factor enabling regional banks to remain deeply embedded within global value chains. At the same time, Southeast Asian banks have assumed an entirely new and challenging role, becoming sophisticated managers of geopolitical risk. The U.S. China trade conflict does not follow traditional economic patterns. Instead, it evolves unpredictably according to political decisions made in Washington and Beijing. The United States has continually expanded sanctions lists, tightened rules of origin requirements, and imposed stricter anti-circumvention measures. As a result, companies relocating to Southeast Asia increasingly find themselves under scrutiny. If a bank unknowingly finances a Southeast Asian company that is effectively a Chinese shell operation, importing components from mainland China and re-exporting them to the United States without meaningful transformation to evade tariffs, that bank could face secondary sanctions from the United States, including the loss of access to the U.S. dollar payment system and SWIFT network. For any international financial institution, such consequences would be catastrophic. To mitigate these geopolitical risks, Southeast Asian banks have transformed their risk management frameworks. Instead of focusing solely on credit risk, the borrower's ability to repay, they now conduct extensive assessments of supply chain security and international regulatory compliance. Know Your Customer, KYC, and Know Your Customer's Customer, KYCC, procedures have become stricter than ever before. Risk analysts are now expected to understand White House executive orders and U.S. Department of Commerce sanctions lists as thoroughly as they understand financial statements and balance sheets. They must be capable of tracing the origins of raw materials and supply chains to ensure compliance with free trade agreements such as CPTPP and RCEP, while avoiding any accusations of tariff circumvention from U.S. authorities. As a result, banks are no longer simply providers of capital. They have become geopolitical filters, helping shape a community of compliant and internationally trusted manufacturers throughout Southeast Asia. Furthermore, geopolitical uncertainty has generated significant instability within broader financial markets, particularly in the areas of currency volatility and capital flow reversals. Southeast Asian banks are increasingly developing complex defensive strategies to protect their balance sheets from currency shocks. When U.S. China tensions escalate, the Chinese yuan often depreciates, placing downward pressure on many Southeast Asian currencies due to strong regional trade linkages. Conversely, when the U.S. Federal Reserve maintains high interest rates to combat inflation fueled by supply chain disruptions, capital frequently flows back toward the United States from emerging markets. To attract and retain redirected manufacturing investment, regional banks cannot rely solely on short-term domestic funding sources. Instead, they must diversify their funding bases by expanding access to long-term foreign currency financing through international bond issuance and global interbank credit facilities. At the same time, they must provide corporate clients with sophisticated financial instruments such as forward contracts and options to hedge exchange rate risks, especially when revenues are generated across multiple currencies. Viewed as a whole, the U.S. China trade conflict has triggered a forced evolution within Southeast Asia's banking system. Institutions that once operated primarily as local lenders focused on real estate and consumer credit have now been pushed to the front lines of a global economic contest. Banks that are slow to abandon outdated thinking, fail to upgrade their cross-border trade finance capabilities, or underestimate geopolitical risks will quickly find themselves excluded from emerging value chains. In contrast, institutions willing to transform themselves into sophisticated risk managers and builders of flexible supply chain financing solutions will not only capture the enormous capital flows entering Southeast Asia, but will also help elevate the entire region to a new stage of development. In doing so, Southeast Asia has the potential to emerge not merely as an alternative manufacturing base, but as an independent, resilient, and strategically significant center of both production and finance, capable of withstanding whatever geopolitical storms the future may bring. When the ecosystem adapts, how Southeast Asian conglomerates flexibly respond to the transformation of the banking system in the post-trade war era. The U.S. China geoeconomic conflict extends far beyond tariffs and technology sanctions imposed by Washington and Beijing. As structural fractures between the two superpowers push the global financial system toward fragmentation, a powerful evolutionary chain reaction has been triggered across Southeast Asia. As a natural consequence of the transformation occurring within regional banks, which have abandoned traditional lending models to become sophisticated managers of geopolitical risk, leading manufacturing and business conglomerates throughout Southeast Asia have also been forced to adapt. To survive and optimize capital flows in an era where supply chains are shifting at unprecedented speed, major corporations in Vietnam, Indonesia, Malaysia, Thailand, and Singapore have undertaken sweeping reforms in financial management, capital structure and operational strategy. Their goal is clear: align themselves perfectly with the new standards imposed by the evolving banking ecosystem. To fully understand the nature of this adaptation, it is essential to recognize that Southeast Asian corporations now operate under an entirely new framework of financial scrutiny established by major regional financial institutions. The emergence of stringent risk control procedures, including deep supply chain audits and rigorous origin verification requirements implemented by leading banks such as DBS and OCBC in Singapore, Maybank in Malaysia, and Vietcombank in Vietnam, has effectively ended the era of easy access to capital based solely on attractive financial statements. Today, corporations throughout Southeast Asia understand that if they fail to proactively increase transparency and restructure their supplier networks in accordance with international standards, they risk being cut off from cross-border trade finance, the lifeblood of modern global commerce. The first and most visible adaptation among large-scale manufacturers has been the aggressive diversification and localization of supply chains to satisfy increasingly strict banking requirements aimed at preventing exposure to secondary sanctions. Consider major industrial and technology companies in Vietnam, such as VinFast, as well as businesses operating within the electronic supply ecosystem linked to Gelix. These firms quickly recognized that excessive dependence on Chinese raw materials or semi-finished components could result in supply chain financing applications being rejected or subjected to significantly higher risk premiums by major banks. To address this challenge, corporations have proactively invested in local suppliers and strengthened partnerships with satellite manufacturers across ASEAN countries, such as Malaysia and Thailand, increasing the proportion of regional value-added content within their products. This strategy not only enables them to comply with stringent U.S. rules of origin requirements, but also transforms their financing profiles into highly desirable, clean credit portfolios, making them attractive candidates for preferential trade finance rates offered by banks. Adaptation has not been limited to physical supply chains. Southeast Asian conglomerates have also demonstrated remarkable agility in restructuring capital sources and adopting advanced financial derivatives to align closely with banks' currency risk management strategies. As the Chinese yuan and regional currencies experience persistent volatility under pressure from high interest rates maintained by the U.S. Federal Reserve, corporations have abandoned the traditional practice of managing cash flows separately within individual countries. Instead, they increasingly collaborate with treasury management divisions at major financial institutions such as UOB and CIMB to establish centralized payment and liquidity management centers. Large Indonesian corporations such as Astra International, along with diversified conglomerates like Thailand's Charoen Pokphand Group, have accelerated the adoption of reverse factoring programs provided by banks. Rather than forcing smaller suppliers to secure expensive financing independently, these corporations leverage their own creditworthiness and banking relationships to support suppliers across their ecosystems. This allows suppliers throughout the entire value chain, from upstream producers to downstream manufacturers, to access affordable working capital efficiently, reducing liquidity bottlenecks caused by geopolitical uncertainty. To illustrate the effectiveness of this mutual adaptation, it is important to highlight the pioneering initiatives undertaken by Southeast Asia's leading banks in designing specialized financial tools that help businesses navigate trade disruptions. At the forefront of this movement stands Singapore's DBS Bank. Recognizing that multinational corporations relocating production to Southeast Asia frequently struggle with cross-border documentation and data synchronization, DBS launched a blockchain-powered digital trade finance platform directly integrated into corporate enterprise resource planning systems. According to DBS annual reports, the platform has reduced approval and issuance times for letters of credit supporting exports from Southeast Asia to Western markets to less than 3 hours. A record-breaking achievement that significantly lowers inventory risk and foreign exchange exposure for exporters. Similarly, in Malaysia, Maybank has proactively developed a trade finance corridor connecting the countries receiving the largest influx of relocated foreign direct investment, particularly Malaysia, Vietnam, and Indonesia. The bank has introduced green financing and sustainable trade finance packages worth billions of dollars, specifically targeting corporations engaged in clean energy manufacturing, relocation projects, and the construction of next-generation smart industrial parks. This strategic adaptation perfectly matches the needs of major corporations seeking both abundant working capital and stronger ESG, environmental, social, and governance credentials, which are increasingly critical for maintaining unrestricted access to U.S. and European markets as non-tariff regulatory barriers continue to tighten. In Thailand, Capricorn Bank has pursued a deeply localized strategy by expanding its branch network and establishing strategic financial alliances within key economic regions of Vietnam and Indonesia. Rather than merely offering traditional wholesale banking services, Capricorn Bank has positioned itself as a comprehensive strategic advisor for Thai corporations seeking to diversify investments beyond domestic borders, partly in response to Thailand's own demographic challenges. The bank provides end-to-end geopolitical risk management solutions, including legal due diligence, assessment of local investment environments, supply chain integration support, and the structuring of multi-currency syndicated loans. These services help Thai corporations maintain continuity, flexibility, and security in their overseas investment activities. In Vietnam, leading state-owned and private sector banks, such as Vietinbank, BIDV, and Techcombank, have also adapted rapidly to keep pace with the evolving needs of large corporate clients. As enormous volumes of foreign direct investment continue flowing into Vietnam's electronics and semiconductor industries, Vietnamese banks have strengthened their internal capabilities by creating dedicated international trade finance divisions staffed by specialists with deep expertise in international regulations and U.S. sanctions compliance. They have developed tailored supply chain financing programs specifically designed for subcontractors and second and third tier suppliers, supporting global corporations such as Samsung, Foxconn, and Intel within Vietnam. These initiatives create a robust financial foundation that enables local businesses to invest confidently in technology upgrades and production expansion, allowing them to integrate more deeply into global value chains. At the same time, they help address concerns among international financial institutions regarding compliance standards within Vietnam's financial system. Looking at the broader macroeconomic picture, the adaptability demonstrated by Southeast Asian conglomerates in response to changes within the banking sector provides compelling evidence of the region's resilience and self-correcting capacity. While the U.S. China trade conflict has undoubtedly introduced significant risks and challenges, it has also served as a powerful evolutionary pressure, compelling both financial institutions and manufacturing enterprises throughout Southeast Asia to abandon outdated management practices and elevate their capabilities to global standards. The increasingly symbiotic relationship between geopolitically aware banking institutions and highly adaptable corporate supply chain ecosystems is reshaping Southeast Asia's economic identity. The region is no longer merely a passive manufacturing destination dependent on foreign capital and technology. Instead, it is rapidly emerging as a sophisticated, self-reliant economic system supported by a resilient financial infrastructure, one capable of withstanding the uncertainties and disruptions of an increasingly multipolar world order.